Today, though, we wanted to take a bit of a different framing, given kind of market conditions, and then B, because we have been busy over the last several months gathering viewpoints from accounting and finance executives across the biopharma industry and compiling into our mid-year outlook report. So we're going to share some of those findings today, but we thought it would bring those findings more to life if we brought folks who are actually kind of living the day-to-day in the biopharma industry. So today I'm joined by Sean McGregor, Executive Director from J.P. Morgan. He's a healthcare investment banker covering the life sciences sector, I believe out of Boston, Sean?
Out of New York.
Out of New York. That's where all the investment bankers are. I should have known that. And then when we get into like actually life in the CFO seat, we have Kelly Gold joining us. She is the CFO of CAMP4 Therapeutics, and she's in Boston.
Correct.
Cool. Okay, awesome. So I'm going to give you guys just a couple minutes to introduce yourselves. Would love to hear kind of backgrounds. I think Kelly would be great to shed light on how you got into the CFO seat from a background standpoint. So why don't you guys take it away?
After you, Kelly.
Sure. So I have been at CAMP4 for 8 years now. So since inception, I have held various roles at CAMP4, head of finance, chief business officer, and then took the CFO seat about 3 years ago. I came here by way of FP&A at Biogen, did a brief stint in investment banking prior to that, and actually started my career as a mechanical engineer. So I've had a non-linear path to the CFO seat, but very exciting to be here.
And Sean McGregor, I sit in the investment banking group at J.P. Morgan in New York. I cover emerging growth biopharma as well as large pharma. So for emerging growth biopharma, help them as they think about capital formation opportunities as well as strategic alternatives. I've been with J.P. Morgan for 4 years. I spent time at Citigroup also covering biopharma, and I have a background as an attorney. I worked at Skadden Arps in New York doing corporate finance and M&A work.
Awesome. Thanks, Sean. I will say that I spend most of my day and obviously at Auxilius in these webinars speaking with accountants, and as a former quick stint investment banker as well, it's exciting to have all these investment bankers in one place. So let's dive in. Again, just to kind of recap the agenda, we're going to talk with Sean on state of the market. It's an interesting time to be in biotech. Hoping Sean gives us some insights, shares his crystal ball on what this market is going to do over the foreseeable future, and then also give us some framing for how we can be positioning ourselves, our companies, our stories in terms of kind of market positioning. And then we'll turn to Kelly and actually talk about how she's putting some of the kind of insights that Sean's going to share from a market perspective into practice on the operational side. Obviously, we're interested from the Auxilius view in how, considerations on efficiency and automation and scalability and team are factoring into kind of the day-to-day life of a CFO. At the end, I will go over kind of what we're seeing are strategic imperatives of our over 80 biopharma customers, and then talk through some tactical considerations to ensure that reporting is tight as we're talking about storytelling and positioning to the market. So with that, Sean, I'd love for you to describe the current state of play from your perspective, specifically probably focused on clinical stage biopharma right now from an investor's lens. I think we have a mix of private and public companies on, so would love to kind of hit both of those frames.
Yeah, no, happy to. So it's obviously a really tricky and fragile market right now that we're sitting in amidst all the uncertainty and volatility that we've seen over the course of the last few months since Liberation Day, as well as just since the election in November. If you think about just, framing performance across the biotech sector and the broader macro sector, the XBI is down 12% since the November election and about 5% down since year to date. Whereas the S&P is up 8% since the election and 8% year to date. So obviously the broader macro environment amidst all the things that have been going on from a macro perspective have improved. Biotech has been faced with some particular headwinds. Some of the key things that we've all been facing is obviously the changes at the FDA, the impact that that's going to have on clinical stage biotechs in terms of the regulatory pathway, the approval pathway, as well as just as you think about trial designs and potential delays there. Obviously, with the administration putting forth potential policies on MFN, policy, major tariffs on large pharma, what are the impacts of that? We've also seen potential IRA reforms being proposed that would be a benefit to the sector. And then just another overhang or kind of key theme within the sector is just innovation coming out of China. So a lot of in-licensing by large pharma coming from some of the companies that are building out new assets or follow-on assets out of China. So that's what we've seen from a kind of a theme or policy perspective. I think as you think about how investors are reacting to this, investor sentiment has significantly improved over the last, I'd say, 30 to 60 days. So we've seen a number of public companies have some significant catalysts in the public markets, and in which the stocks have reacted favorably on the back of those catalysts. And those companies have been able to finance themselves and have appreciated in the aftermarket as a result of that. So that's all signs of a positive and functioning market. I think there's limited cases right now. So those are good examples, but it's not widespread. It is, some of the best companies with the best data sets that have been able to do that and been able to raise the capital to fund themselves in the long term. We still need more proof points in the market to feel like we're back on solid footing. So I'd say that's when I said it's fragile. It's fragile for now just based on some of the readouts that we've seen, but we've obviously seen that the market is tipping both ways. It's tipping for those companies that have these key readouts, that have access to capital, and that have the ability to fund themselves through the next set of inflection points. But we're also seeing companies on the other side of things who may have less access to capital, less near-term inflection points, and so it is difficult for and they're thinking through many different capital formation options in order to get through their next set of clinical catalysts. So, and one of the themes that has emerged for those companies who have put out data sets that are not reflective of what investors were expecting, we're seeing many of those have activist investors come into their stories. We're seeing some of those being acquired by Tang Capital's Concentra Biosciences, and that's become a bit of a newer theme for those companies that are out in the public markets with significant cash balances, and instead of going through reverse merger processes, are looking to send capital back to their shareholders. If you think of, to your question, Aaron, just in terms of what investors are looking for, investors are still looking to deploy capital, but the diligence process is significant right now. In this period of uncertainty, they have the ability to be very particular and disciplined about those opportunities in which they want to deploy. And many of them are looking into the public markets for those opportunities as opposed to the private markets because of the liquidity in the public markets, as well as the ability to look for names that might have some type of arbitrage on value. They feel like they're undervalued today. Those companies have catalysts that are upcoming in the next 3 to 6 months in which they can do some significant work, but they're not too far out. I'd say that most investors are focused on those catalysts that are in the calendar year and less focused on what's occurring in 2026, just given they don't have to focus on those stories quite yet, and there might be an opportunity to come into those stories in the early part of next year. From a private perspective,
before we get in private, can I ask you one follow-up question? Because I think it's a very interesting point that folks that have dry powder are still willing to go, but they want to take advantage of the public markets as partially a risk mitigator is what I'm hearing. From a sort of investing in the public markets perspective in general, how, if at all, have you seen a shift in generalist investors' appetite for the sector? I think everyone probably piled on in 2021, and just wondering how you're seeing that if we're talking through public sector to start.
Yeah, certainly generalists were within biotech in the 2020-2021 period in which there was significant growth and appreciation within the sector. There's less focus from generalists into the biotech sector, just given all of the headwinds we've seen, all the uncertainty, and the other sectors have seen much more appreciation in recent months, are less affected by some of the idiosyncratic challenges that biotech is facing. I think we need a prolonged period of appreciation within the sector and some resolution of some of these challenges that we're facing in order for them to come back in earnest. I think we've seen a little bit of participation out of generalists in some of the recent transactions that we've done. So as mutual funds are participating and some of the generalists coming back into those stories, but they're coming into the best in class stories. They're coming into the names that have produced really de-risked data sets and feel like they've got significant commercial opportunities and or the ability to win in those indications or those therapeutic categories. So it's limited examples of that right now, and I think it might still be a way off. Okay. Just on the private capital side, so the compelling valuations in the public sector just creates a really high hurdle for these investors as they're looking about putting capital to work in the private sector, in particular for those investors that straddle the private and public markets. And as you think about some of the performance that some of the funds have had over the course of this year, performance being challenged in the public markets, and then thinking about what is for private companies that they're already supporting with the IPO market we haven't seen an IPO in over 5 months right now. So the IPO market is not quote unquote open for new private companies to go out there and raise capital and be a public company. So these investors realize that they're likely going to have to fund these private companies that they're already invested in for a longer period of time. So they're allocating capital that needs to be deployed into those companies that they're already supporting. So there's a little bit of earmarking of that capital for those opportunities as well.
That makes sense. So now to the crystal ball question. I've asked Sean this before, and he said this is the question everyone asks him. So tell us when it's going to get better. I'm going to take the eternal optimist view and assume that we are going to see some thawing. We did see, I think all of us who are closely monitoring the biopharma sector saw the MedPace earnings report yesterday where the CEO mentioned that cancellations were down. I want to take this as a silver lining. I'd love your take though, Sean, on what you're seeing, where we're going.
So from that perspective, with MedPace's earnings, I feel like a lot of companies have done a good job of reprioritizing their pipelines as a result of feedback from investors and preserving capital in a way that pushes out their runway and funds them through those key inflection points. And so we've seen a downtick in the number of programs we're seeing on companies' websites about opportunities that they're going to be going after. And I think we've seen a downtick in the number of clinical trials that are being started as a result of that. I think there might be a second culling as to the extent that we are in this protracted period of lower volume capital markets activity. So I don't think it's quite over yet. I don't think the pendulum has swung back in which there is significant access to capital. The cost of capital today is still really high. It takes a lot for companies to get themselves funded in today's current market environment. I mean, and just thinking about volumes in the public markets, we're at an annualized pace for about $15 billion of equity capital through follow-ons, IPOs, pipe transactions. That compares to $47 billion that we saw last year. So significantly down based on current projections. We only did about $8 billion in the first half of this year thus far. So we still need to see a return of companies being able to fund themselves in order to feel like we're in a better position from that perspective. But to your question on what is the silver bullet here, a lot of people like to look to M&A, and I think we have seen a significant uptick in M&A over the course of the last 2 months, which is obviously healthy, and the ability for investors to be rewarded for coming into those names and the ability to distribute that cash or redistribute that cash into other companies within the sector. Those are all positives. But I don't think it's the silver bullet we're looking for. I think what will really help us in the sector is obviously some resolution on some of those challenges that I noted at the start, as well as some of the rate cuts that we're expecting in the second half of this year. So to the extent we see some of the resolution on IRA, tariffs, we start seeing a little bit better cadence from a regulatory perspective on approvals, and I guess less pushback. We're seeing a lot more in the news with respect to the FDA over the course of the last week. I think we'll hopefully see a return to some, or a more positive sentiment heading into 2026.
Great. I'm going to take that as optimism is around the corner, but yeah. I appreciate that perspective. Okay, I want to shift a little bit, just in terms of, and you've mentioned this a little bit, you talked about the investor diligence process. How are investors' questions shifting from questions 12, 24 months ago? And how are kind of the successful biopharmas, biotechs repositioning to answer those questions?
Yeah, I think the focus from investors today is they're being much more careful in terms of what are the use of proceeds from a potential fundraise. How is this going to give you, what they're more focused on how each dollar is spent than they ever were. So in 2020, 2021, they were funding platforms, they were funding hopes and dreams. That is no longer the case anymore. They're funding very specific programs to specific inflection points in which they're very focused on, looking at how you're going to de-risk the program or the company over this time period. And so they're looking at stories that have some de-risking from a target biology, mechanistic perspective, that have significant market opportunities, and that have the ability to demonstrate some differentiation relative to the competition. So I think they're focused on all of those things, and they're focused certainly in the public markets on those names with near-term inflection points, because that's top of mind for them.
That makes sense. And then just given we're talking with an audience of operators, you talked about where the focus needs to be, defensive use of proceeds. What are things you see management teams and finance teams do to give you confidence in their company as an investment? I think this is more of a question on what can folks on this phone do from a team standpoint, from a story standpoint, to set themselves apart.
Yeah, they're looking for good stewards of capital right now. I think they've seen management teams who have had significant amount of resources, and over the course of the execution of those programs still wonder, what they were able to advance and succeed on. So I think the real focus is on management teams that they trust and believe in, management teams that they feel like will be able to get the job done and execute, especially in an environment where things are very tricky from a regulatory perspective, in which they need to have high confidence that they're able to do so, and preserving capital, being able to fund yourselves and preserve capital through those inflection points. That's really what they're focused on. And if they cannot trust a management team to do so, that is when they'll look to put their investment elsewhere. So that is really what they're focused on. It's hard for them all the time to see what's going on behind the scenes, but they really have to have a lot of trust in the CEO and CFO that they're conducting themselves in the right way, and that they're planning and executing on what they've said.
Yeah, I think it's actually an awesome segue to talk to Kelly here, given her track record in the sector. I think that's what I'm hearing mostly from you. We need more news. We need more stability in a fairly volatile sector. But then also we need operationally the ability to defend use of proceeds, to be able to show that while you can talk about what your use of proceeds are, that you have a track record of actually being a good steward in the past. Thank you, Sean. Any closing thoughts from you or any questions, please put them in the chat for folks on the phone.
Yeah, happy to take any questions at the end as well.
Awesome. So Kelly, let's shift over to you. Operating a biotech in this market. I'd love to hear any kind of responses to Sean's perspective. Does your crystal ball say anything different?
No, I a lot of what Sean said really resonated. I think maybe just to give a little bit more of the perspective of what investors are looking for from, the perspective of a company who is, in many ways always raising capital. I think that, the nature of what they're looking for has not changed, but the timelines have really changed. I think that in this market, because there are a lot of companies raising at any given point, and, there is definitely an understanding that there is an imbalance between supply and demand here. I think things are just taking a lot longer to happen. And as we all know, there's deal risk anytime a transaction takes more and more time. And so I think that's one thing that there's not really a sense of competition or urgency. And so, and we're also at the same time, I think, from the operator's perspective, hearing from investors that they're really interested in the story, but there are so many stories coming to them at this point in time, which I think is also forcing them to prioritize those names that have nearer term catalysts. So you do sort of feel like you're competing for investor attention, and also in some cases having to create a sense of urgency where there otherwise isn't one. So definitely everything Sean said resonated, and I'm certainly living that on this side of the table as well.
I think taking that kind of one step further, you've agreed with Sean, you framed the market well. It would be interesting for me to understand how you think of the role of the CFO in a period of this uncertainty. So we know the challenges you face. So how do you combat those?
Yeah, I think it's to borrow Sean's term, it's being a very good financial steward. But what that looks like is, it's no longer, I would say, we had the heyday of 2020, 2021, and then things got tighter. It wasn't, the flow of capital was not as free. And so everybody has already gone through their processes of rationalizing expenses. And, then we all took it a step further, and we all really looked at our pipelines. And I think we are now at a point where every dollar is so precious because the cost of capital is so high that truly, I think, number one, sitting in the CFO seat, you really need to know where every dollar is going. There can't be any sort of black boxes of spend. You really need to understand where the dollars are going and be able to justify to your investors, to your board, to the rest of your leadership team, why you're choosing to deploy capital in certain areas and not others. And I hate to use the term cut the fat, because I don't think any company has any fat on it anymore. We've all cut and cut again, and looked at multiple places. And I think in the last quarter or two, we've definitely seen a lot of public company announcements about reducing headcount. I mean, they've pulled every lever they can. And so I think now it's knowing where everything is going, being able to justify it, and also knowing what you would do if things got worse, which is an uncomfortable thought exercise sometimes, but you can never be caught off guard. And, we would all we all know what we would do if things got better and capital would become more free flowing. But right now, I think we'd also have to know what happens if things get leaner before, things thaw out.
Yep. From the CFO's chair, what's the most underappreciated challenge right now in keeping the lights on and pushing the science forward?
Honestly, I think that I probably will be the first person to publicly say that I think a CFO can actually be a steward of culture at a company, but I think it's really easy to sort of be the heavy-handed cutter of costs. It's not easy to do that in a way that you can get buy-in across a management team, across a company, and really do it in a way that it still engenders optimism across your entire, group of employees who are seeing that we're making cuts, who are looking at their peers at other companies who are losing their jobs. And so I think to continue to tighten your belt in a way that, doesn't sort of make it sort of clear to the rest of the employee base that you are facing leaner and leaner times, I think is a really important and underappreciated challenge. And I think done the right way, you can actually sort of create a sense of ownership of, that this is the financial fate of the company is not solely in the CFO's hands, it's in everyone's hands. And I think it can be kind of a rallying cry for people to come together and think creatively and, sort of join hands and say, okay, well, we believe in the mission here. And even though we have to do more with less, we can do it. And I think that the CFO can play a critical part of that process.
Yeah, I think that's a great point. One thing I think it's interesting, I know, again, a lot of the Auxilius customer base and a lot of the folks that we interact with quite a bit are a little bit more on the accounting side. And I think, Kelly, you mentioned your background is in FP&A. Mm-hmm. And in our prior conversations, one of the things you mentioned is that FP&A gave you the tool set to be able to be that steward of capital and to have a really strong understanding of the levers of projected cash usage and what your best and worst case scenario is going to be. I think it'd be great to understand, like, from the CFO, what does that actually look like? What is your, I know I asked you these questions on like how granular are you getting, but it would be great to understand how versed are you in where every dollar is going? What is your toolkit to do that? What is your like recalibration cadence, et cetera?
Yeah, look, I think that I would be lost without my accounting counterparts. Truly, I think anybody who chooses a career in finance is an inherently data-driven person, and I'm no different. And, it's very, very hard to affect any kind of change, particularly when it comes to change around spend, without being able to show people at a very granular level what historical performance has been, and by that I mean where we historically been spending, where are places that we didn't realize that we were spending, as much as we are, where are places that we can be more efficient. Often I find that people, my sort of business counterparts at the company are, often surprised by some of the data that we share, but it's having that kind of granular data that can really get people sort of on board with some kind of an initiative to either reduce costs or in many cases just change behavior. Reducing costs isn't necessarily saying we're no longer spending on XYZ. It's saying we're still going to spend on XYZ, but we're going to figure out based on our data how to do it in a better, more efficient way. And so I think that all starts with historical data. And a lot of that actually does come from, the R&D side of the house. We rely on them to be granular in placing orders. We rely on them to, log every week how they're spending their time. And it's not because we're trying to keep tabs on people, but it's because when we have historical data, we can better project a number of people we need, the resources in general that we're going to need to do something similar going forward. And I think that is, going back to knowing what's coming and being prepared for things to get worse. I think that's sort of the most critical thing to be able to point to your historical data. And I think that typically once people across the company in all functions have seen the benefit of what future behavior informed by historical data can have, then they are, definitely more bought in and participating in the process of collecting and ensuring the integrity of that data going forward.
And then I want to double click on one thing you said, and I think this is a theme we see. Auxilius is obviously finance and accounting software, but one of our key stakeholders is clinical operations because, and from where we sit, we see a wide spectrum of how the relationship occurs between the finance and accounting teams and their clinical operations counterparts. On one side of that spectrum, we see like highly transactional clinical, you need to give us this data, you need to give it to us by this time in the month, we need more and more data, and it is a very like kind of that relationship. I think on the other side, what we see, and I think what you're alluding to is this like partnership between clinical and the finance and accounting team. One of the key things we always say is that finance and accounting needs better clinical fluency to be able to be thought partners back to the R&D team. I wonder kind of how you characterize the relationship you guys have finance and accounting wise with your clinical counterparts, and if you'd offer any advice to folks on the phone.
I think you hit on all the right points. I think it absolutely, and this is not just for clinical, it's anywhere in the business. There has to be a true relationship there. I mean, you really do need to be embedded with, regulatory early discovery, clinical operations. And that's just because, and particularly for clinical, just because it tends to represent such a large proportion of a company's expenditures. I spend more time talking to our clinical counterparts than probably most other people at the company, and so do the people on my team. And the reason for that is it's such a significant driver of our expense, but it's also something that can change so significantly for reasons having nothing to do with, finance or CAMP4, that enrollment is faster or slower than expected. We anticipated a site coming online and it didn't for 2 weeks past when we anticipated. And these kinds of changes can have very significant influence on the timing of when we incur expenses. And so, particularly when you are a non-revenue generating company, you're not just thinking about what are we accruing, what are we booking, you're also thinking about when are my significant cash payments to this CRO, because they are, typically sort of sporadic and quite chunky when they do happen. That's a technical term. I think that being embedded with your, as a finance professional, to be embedded with the clinical team in particular, and really just ask questions. I mean, I think that you can always ask the basic, when are we starting? How many patients? When do we expect last patient out? When do we expect a final report? Those are, to me, the sort of basic questions that the finance professional is going to ask. I think that where I've always wanted to go with our R&D team or with the clinical operations team is, well, what are the drivers? What are the risks here? What might not happen? I see we want to go into a second geography. When are we going to decide to deploy those dollars, and how will we know that they are de-risked enough to pursue a second geography? And have we thought about more sites in a single geography as opposed to across multiple? I think that sometimes you've got to sort of create that sort of intellectual curiosity around a program overall, because you really do need to understand every moving part. And while I think there are, it is highly possible to be a decently successful financial professional by having that sort of, I guess, inch deep understanding of a study and expect a lot of information to come to you. I think when you establish yourself as a finance business partner who wants to know that information and who can be trusted within a conversation, knowing, where you're sharing that costs may increase or decrease, I think that is really the most important thing. You want to be thought of as a true business partner and someone who can be trusted, and not, sort of the last person who should know because something's going to be over budget. And I think, that to me is the marker of a successful financial planning and accounting team. The team that is one of the first to be informed about something as opposed to the last.
I think that's a great answer. And I think it actually gives me a big answer to my next question, which is, how are you thinking about managing your R&D spend and cash runway year over year? And then as a corollary to that, how are you future-proofing your financing strategy given policy risks or potential market volatility? I think you've answered question one, which is like, obviously as a CFO, you have quite a big handle, like not a big handle, a very nuanced handle on the levers driving costs within your biggest expense bucket, which sounds like R&D. I'd love to hear kind of how you're future-proofing your cash runway and strategy based on market conditions.
Yeah, and I think, what Sean said really can't be underscored enough, which is about knowing where every dollar is going. And, we really take a very critical look at our pipeline, and we think about, not just what can we fund, but what should we fund? What is going to turn into something that is going to have an impact on patients, but will also be appealing to investors. We tend to, in the financial seat, talk about investors and valuation, but we can't forget that really our jobs we're really just here to enable progress in developing medicines, and we don't want to lose sight of that. And so I think there's definitely that focus. In terms of future proofing, I think there's sort of a, what I would say rises to the level of being, shared at a board meeting, for example. Here is our, runway, here's our contingency. If we are wrong, if things get worse, here's what we would do. But then I think there's also, I think as finance professionals now, especially, ones leading companies that are cash constrained and are going to continue to face headwinds in raising capital, data driven or not, I think it's really important to always have an idea of, what are the alternative sources of capital? There's always BD, and it's very easy to say, well, just go do a non-dilutive financing. That would be great. I'm sure we would all be doing that if we had them on the table. And I think that is something that we are heavily exploring, like every other company in our position. So I think the BD strategy becomes more and more important. Even looking at alternative relationships, looking at grants from, certain patient groups or, other areas, even though that's not substantial capital, in some cases it can be, a month of burn. And, when you're talking about operating in an environment with cost of capital being what it is, a month of burn is, is meaningful to get that in a non-dilutive way. And then, we've been exploring all kinds of different opportunities that are, sort of capital markets opportunities that are maybe less common, but, ones that we think we should be well versed in, just to know really what is in our toolkit and to be at the ready to capitalize on anything.
That's interesting. And I wonder, just on that front, are there any particular strategies that are more interesting to you? I think it'd be interesting, to share if there's anything specific. And then I think, Sean, if you have any thoughts on, access to those alternative strategies, I think it'd be great.
Yeah, no, I mean, when I say that we explore these, I'm not saying that we're availing ourselves of them. I'm saying that I think we're in a situation where your board and your investors need to be comfortable that all ways of getting capital, even the sort of less standard ones. I guess one that, not capital markets necessarily, but thinking about royalty deals. I think that's something a clinical stage company should at least kind of understand the mechanics of, and know what those deals can look like, and what the companies who do those deals are looking for, and what sort of financial impact it can have on a company. Looking at other things like ELOCs, for example, that's something that we've explored, just because it's the type of thing that you should be aware of in a market like this. And so when I say, looking at alternative strategies, I really just mean knowing all of the ways that you could be doing something if you really, really needed to, not necessarily having a plan to do them today, but sort of being educated enough about your options to know that if you had to pull a certain lever quickly, you could.
Yeah, I just add to that the menu of options that companies are looking at has expanded over the last 6 months, given access to capital. And so whether that's equity, debt, royalty, partnership, people are availing themselves of all those options and at least understanding what they are. But, there's a sliding scale amongst all of those in terms of, what the cost of that capital is, what is the timeline to get that capital in the door, and what is, at the end of the day, what is the feasibility of doing that? So I think you have to evaluate all that and be able to, ensure that you're optimizing the capital that you can bring in, but also focusing your time and resources at the right one.
Yeah, that's a good point. Yeah, that's true. It actually takes bandwidth to understand the opportunities out there. I think that's actually a great segue. And we're going to kind of get into the kind of final part of the presentation, which is just some of the things we're seeing across our customer base. I want to use what I've heard from Sean and Kelly to make sure that we continue to share these themes. If folks have questions on what we've talked about so far, please let me know. You can put those in the chat. Jesse, the answer is in conversations, not yet. But we have plenty of folks who can tell you about their opinions on our software. I'm glad we ended with the sort of financing options and funding options. If we can pull up the slides. Okay. So as I mentioned at the beginning, we pulled kind of hundreds of accounting and finance folks in our network to understand what the mid-year outlook looks like. You're going to see that this is a little bit more operationally focused relative to kind of some of the insights you heard at the beginning of this session. I think what's interesting is that those macro themes pull through to what we're seeing here. I will start, and as I mentioned, in terms of that segue, 85% of companies are exploring strategic partnerships for funding. So I think this is exactly to Kelly and Sean's point. It is, as a good steward of capital, it is important that you understand what options are on the table. Interestingly, obviously, strategic partnerships are kind of number one. And I think we're seeing this from some of the announcements recently. Continuing into, I think, again, thematically consistent, our kind of second insight is nearly half of life sciences leaders point to fundraising as a driving force behind strategic decisions. I think we all know that we need capital kind of as our first principles, keep the lights on. And so that's what we're all thinking about today. So I wanted to, final insight, so that everyone knows that it's not just Kelly as the mean CFO over there, making sure that there's austerity around costs. I think this is consistent across the industry. I think it's consistent with people who are actually buying our software in the face of cost constraints. They want more visibility via software solution into their clinical trial costs. They want to be able to go back to their vendors and say, I don't think so. That's not what we contracted for. So this one we're seeing thematically also as actually kind of an opportunity for us at Auxilius. We are, folks are really trying to have increased visibility into spend so that they can improve their track record in the markets with investors to ensure that there is further access to capital and ensure that de-risking of the runway. Before I get into a couple of more deep dive slides on the Auxilius side, I just want to mention that all of these insights that we've collected are available in our mid-year outlook report that we'll send out after this call. And then we're happy to jump on the phone and discuss this or more information on Auxilius. And I know there's some questions here around Auxilius, and we're always happy to show you what we're up to. In terms of what we're seeing, so spending a lot of time with obviously our 80 customers, but then also talking to the markets, consistent themes. Number one, strategic deployment of capital. Our view, and obviously we're FP&A and accounting software specifically for outsourced R&D spend. Where we're getting the pull from our customers is the ability to actually defend each of those dollars being deployed and being able to model out where those dollars are going to go. Second thing, internal and external efficiency. That's consistent with what we've heard from Kelly, and then also our insights, and then obviously enhanced ability to accurately report out financials. This is less of a kind of macro pressure today, but it is a consistent headache that we hear from finance and accounting leaders, and it is a consistent focal point from the audit community. So starting on the strategic capital deployment, how do we better equip ourselves with the right data to inform strategic capital allocation decisions? From where we sit, we hear that there are 3 imperatives in 2025, and these are the 3 imperatives that are driving folks to leverage Auxilius in their finance and accounting for their outsourced R&D spend. The first one is that CFOs, that folks, finance and accounting folks, must own a 5-year portfolio level view. And the difference between 5 years ago and today is that you have to have command over those trial level drivers. So you have to have command over what's going to happen, to Kelly's point, if you go into another geography versus expanding in the geo that you're in. You have to have a high case and a low case around your enrollment. You have to have a high and a low case around your ability to deliver against the clinical endpoints that you've articulated. And it is important that those views can be recalibrated in real time. I think that's the other thing, is there is, when Kelly talks about the necessity to drive urgency, you actually have to have real-time data to be able to back up that story around the urgency. The second one, and I think this is super important and it's a little bit nuanced, so stay with me, is you have to understand the timing between expense and cash outlay for capital deployment considerations. This is one of those like tough things in clinical trials, right? We know that we are treating, that we've enrolled our 500 patients. We're starting to see in the clinical data, and that's what folks use Auxilius for, is to translate the clinical data into the financial expense within a period. We're telling our customers, look, I don't care what your CRO is saying, you're at $5 million on your investigator expense. The next question has to be, when am I going to pay that expense? It's another thing that Auxilius helps you with, is to help forecast when, based on the reconciliation we do between your clinical data and when those invoices happen, to be able to identify the lag time across your entire forecasted investigator spend, so that yes, I need to report that there's $5 million of investigator spend, but these are coming in from sites that likely won't bill me for another 12, 18, 24 months. When you're talking about really managing runway, all of those nuances are quite important. The third thing, and I think this was articulated quite well, is defining and defending the uses of capital. So that you have to be able to say, where am I going to deploy that capital? What is it going to cost me? How can I use the data from, analog studies or what I know about the market to ensure that I can give a quite accurate depiction of what I'm going to use this capital for, and then be able to prove that that forecast actually came a reality, or describe where those variances are coming from. The second big thing is, how do we maximize the efficiency of our team and capital when it comes to managing clinical trials? This is interesting, and I think that this is the big constraint and the struggle that we see a lot with our customers. 71% of biopharma accounting teams are under-resourced or need greater efficiency to keep pace with clinical trial demands. The reality is there's not a ton of excess cost to fund new accounting or supplemental accounting FTEs to keep up with the demands around, financial reporting for clinical trials. Now, this is obviously, I'm a technology provider, so I'm going to be quite transparent that we are not at odds with what this slide is saying, right? Over 80% of companies are turning to automation for reduced time to close. Whether you're using Auxilius, whether you're using some solution, we are in the age where we need to stop supplementing necessarily with FTEs as the first kind of point. But it is important to explore some of these automation solutions to replace time-intensive manual processes. Now, when we talk to our customers about efficiency, obviously, we're a financial close product. We do scenario modeling and forecasting of studies. We help drive vendor accountability, but we are a software provider. I think what we hear from our customers is that one of the things that they value about our implementation is helping them see opportunities for efficiency more broadly than just in, closing their books in 2 days versus 4. I think one of the things, and I talked about this with Kelly early on, one of the things we really push is fluency in the finance and accounting team with their clinical operations counterparts. It's key in our platform, and we think it's key in life that our platform facilitates the conversation between ClinOps, finance, and accounting, and lets everyone read out the same sheet of music without ClinOps having to build some big workbook and have to defend their assumptions to finance and accounting. We think that the increase in fluency and the increase in collaboration between the two functions actually is one of the key unlocks to efficiency within clinical trial financial management. Obviously, via automation, we also believe that the smart accounting and finance folks on your team can move to higher value tasks. From an external efficiency standpoint, and I think this is so important, we spend so much money on these clinical trials and so much money with these outsourced vendors. It's incredibly important that someone on the finance and accounting team has a seat at the table at the contracting moment. And I think that's a lot of what we're able to articulate to our customers in implementation is best practices we've seen in contracting to ensure that you are, not caught off guard with the, worst case scenario in 12 to 18 months, that there are clear data coming in from those vendors so that you have a good pulse on what's happening within the study. And then we think it's critically important to have an independent view to hold your vendors accountable. I think the average biotech who is managing to cash runway absolutely cannot handle a $10 million change order that they had no idea was coming. I think it is our view that it is very meaningful to be able to go back to the vendor and say, this is what I asked for. To Kelly's point earlier, am I going to go into a geo? It is really important you know what I think this is going to cost so that you're not at the mercy of your vendor to give you that kind of dollar line item without you being able to corroborate or calibrate. I'm going to skip over that slide. I just in the interest of time, the kind of final thing that I think is really important, and we're always going to ask about kind of how what folks are focused on. I think a little bit self-serving, because what we generally hear is that R&D spend is the hardest to manage. It is the hardest to forecast for. It is also the hardest to account for. So this is on folks' mind. How do we set up controls to ensure accurate and complete reporting? This is kind of looking across CAMs from biopharma companies. As of the most recent 10K filing, R&D accruals are the leading driver of critical audit matters in clinical stage biopharmas. This is not surprising. It's the only thing on your P&L. Of course, this is what the auditors are looking at. It just means that this is where there's going to be a lot of scrutiny in your financial statements. Another kind of interesting thing, in addition to macro pressures and uncertainty in the regulatory environment and challenges with funding, we're seeing finance and accounting leaders also feeling like there's heightened audit scrutiny in the past year. If you think about what I just said on the CAM side, obviously that audit scrutiny is the focus area for those auditors. 86% of our respondents cite clinical trial and R&D expenses as the most effort-intensive audit area. So with my last couple of minutes, I'm going to leave you with a couple of key things that we're hearing and what has helped our customers in this most recent audit season. The first one, and I told you I was going to get a little tactical, but I think this is important. Number one is documented accrual methodology. We're seeing a huge push towards ensuring that auditors can see that there is a clear methodology, that the methodology was followed, but that there was judgment exercised, and that any deviation in that methodology is well documented, kind of across the board and historically accessible. The second key thing that we're hearing across the board and folks are using our platform for is focusing on completeness and accuracy. Now, the prevailing wisdom, although this changes quite a bit within this landscape, is that there's a huge need to confirm with vendors on what the expense was within the study. What we believe at Auxilius is that it is very important to triangulate across multiple sources to identify gaps and/or discrepancies. This means that you need to use your own clinical data to calibrate what the vendor is reporting on the investigator side. You need that not only to book a more accurate expense, but you also need it because there are treasury implications. There are implications for how much you've expensed relative to how much you've paid and when you are likely going to pay that amount. We also think that in general, as a rule, the vendors are focused on delivering the service and not necessarily delivering the most accurate vendor confirm. And that's where it's critical that you have your ability to corroborate what the vendors are reporting before you book that journal entry. And then the final thing, and I think this is, when we talk about intense audit review, we saw a kind of higher requirement for documentation of evidence of review across all workbooks. Certainly, we have opportunities in our system across the board to document evidence of review, but it's not enough anymore to click the reviewer and the preparer button. You actually need to show that you have a pretty significant handle on what's changed over time, what's driving that change, why your expense estimate is the way it is, why your investigator spend is different from what your vendor said. So all kind of key things that we are seeing folks need to bake in to ensure the most accurate financial reporting. I think to bring it back to the whole steward of capital conversation as a necessity in 2025, having the most accurate actuals is going to set you up for the ability to forecast spend most accurately. So I know we went through so much within this session. I want to bring the speakers back out and just say thank you so much to Kelly and Sean for joining me today. Hopefully folks learned something. Would be happy to answer questions here. And if not, thank you all for joining. Thanks, Sean and Kelly, so much for joining us, taking your time today.
Thank you.
Thank you.
And here's to silver bullets and better days ahead. Thanks, everybody.
Take care.